We've had a surprise interest rate increase from the Reserve Bank of Australia, and then the latest decisions from both the US Federal Reserve and the European Central Bank. Now, it's the Bank of England's turn, and Governor Andrew Bailey and his colleagues on the Monetary Policy Committee will announce their latest monetary policy pronouncement on Thursday, the 11th of May. Now, so far, the Bank of England has taken the headline base rate from 0.1% in November 2021 to 4.25% with a series of quick-fire hikes ranging from 1/4 to 3/4 of a percentage point. It's also started to unwind some of the stimulus provided with a quantitative easing programme by shrinking its balance sheet at the rate of £80 billion a year. That so-called quantitative tightening scheme, well, it's a relatively small sum compared to the £895 billion pumped in by the asset purchase programme, but by the end of March, the Bank of England had pruned its holdings of gilts and corporate bonds to just under £826 billion. The consensus expectation is that QT will remain at its preset rate, so the real interest will lie in the decision on interest rates and also how the vote looks. Here, the Bank of England is still fighting inflation on one hand, trying to support a fairly torpid and indebted economy on the other, all while keeping an eye on financial stability in the wake of Trussonomics and autumn's gilt market turbulence, as well as the ongoing banking wobble in the USA. As I sit here, markets are pricing in a 1/4 point rate rise at this meeting of the MPC to 4.5%, followed by another quarter in August and one more in September to take the base rate to 5%. That's expected to be the peak, with 0.25% rate cuts currently expected by markets in February and March 2023. On the corporate front, we're right in the middle of a very busy annual general meeting or AGM season, and keep an eye open on those for any trading updates that accompany them. In terms of scheduled statements or results, the slate's pretty busy, even allowing for the additional bank holiday Monday, with a handful of FTSE 100 firms and a longer list of mid and small caps due to report. Names which could be worthy of further research include the following, although some of these dates could yet still be subject to change. After a blank Monday, Victrex, Direct Line and TT Electronics on Tuesday the 9th of May, Compass, Melrose Industries, TUI, Dignity and Virtue Motors on the 10th, Rolls-Royce, 3i, ITV and IQE on the 11th, before Beazley and Balfour Beatty will round out the week on Friday the 12th. But in the coming week, it might just be a member of the FTSE 250 index that causes the biggest fuss, and that company is ASOS. The fast fashion retailer is scheduled to release its first half results for the 6-month period that ended in February on Wednesday the 10th. Now, ASOS shares are down by almost half over the past 12 months, and that fall has occurred even though the stock shifted from AIM to the main market in February 2022 and was then promoted to the FTSE 250 index last June. There can be no better reminder of how it's the fundamentals of profits, cash flow and valuation that matter over the long term, not piffle about what index a stock is in, or index entry can spark near-term fund flows from index buyers. Even after a 50% rally from last autumn's lows, the shares trade no higher now than they did in early 2010, hampered by profit warnings in June and September last year. The cost of living crisis and the squeeze on the pockets of ASOS shoppers, or the parents' pockets, input cost inflation, increased product returns, bad weather and stiff competition all hit home last year when sales rose 1% and profits fell 90%. But nevertheless, rally the shares have, even if January's trading update was no great shakes, as it revealed a 4% drop in sales, with Europe offering growth and the UK, USA and rest of the world a decline. The good news was the absence of fresh bad news, in other words, no further profit warning, as Chief Executive Jose Antonio Ramos Calamonte stuck to his guidance for the full year and flagged progress in his Drive and Change restructuring programme. ASOS has also renegotiated its bank covenants to ease any fears over a cash flow squeeze or credit insurance. Mr. Calamonte's guidance for the year will be the benchmark by which these first half results will be judged, along with any reference to or changes in the full year outlook. Now, the key elements that Mr. Calamonte has discussed so far are a first half loss as ASOS tries to work through bloated inventory by discounting, a second half profit thanks to improved gross margins as a result in terms of cost cutting, and also a cash outflow of between £0 and £100 million for the year. Now, in terms of the headline interim figures, analysts and investors will look at three sets of numbers. The first is sales, where the consensus forecast is looking for a 3% drop to just under £2 billion. If Mr. Calamonte makes any comments about the full year to August, the current consensus is for revenues to come in broadly flat at £4 billion. The second number is pre-tax profit. In the first half last year, ASOS made a loss of £16 million on a stated basis, and that's the benchmark this time around when another deficit's expected. For the full year, analysts are, however, looking for a profit of around £60 million against last year's £32 million loss, though do watch out for the impact of a £100 to £130 million inventory write-down and £40 million of restructuring costs, as they will puncture the statutory numbers. Finally, analysts look to the balance sheet. ASOS had £153 million of net debt at the end of its 2022 fiscal year, as the purchase of the Topshop, Topman and Miss Selfridge brands from the fallen Arcadia Group, increased capital investment, much higher inventories and a fall in profits all erased a net cash pile. CapEx was £183 million in fiscal 2022, and the year ended with £1.1 billion of inventory, so do check out those numbers as well. Inventory should be down, helped by the write-off and the discounting, and CapEx is expected to come in this year between £175 and £200 million. Hope that you and your families are all well, in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.